The new trading week for European currencies started with a rather alarming news. Experts at research group Markit Economics released the preliminary indicators of business activity in key European countries. Notably, this data is a leading indicator that, if monitored, can give some insight into the future behavior of the economy. Data showed that preliminary estimates differed considerably from expectations. The euro area serves purchasing managers index fell to 51.10 from a 52, below forecast of a 51.5 points. The manufacturing PMI dropped to 42.7 from 43.4, while economists predicted a slight rise to 43.5. As a result, the composite index stood at 48.9, shy of the 49.8 median estimate and last month's reading of 49.9. This gives credence to fears that Europe is stepping into recession. Moreover, given a prolonged decline in business activity in the manufacturing sector, the recession may well turn out to be protracted, and this downturn can be attributed to expensive loans. In addition, the ECB is set to keep raising interest rates. On Thursday, the regulator is expected to deliver another 25 basis point rate hike. However, carry traders who prefer buying the currency whose central bank is tightening monetary policy have not yet reacted. Perhaps they are concerned over extremely weak data on the business activity or political uncertainty in Spain, where no clear winner emerged in the country's parliamentary election. Thus, the euro-dollar pair fell below the key level of 1.1108. If the quote fixes below this level on the 4-hour chart, it will most likely extend weakness, heading for the 1.1061 mark. Nevertheless, Europe's single currency has a chance of regaining ground today, after all data on business activity in the United States is expected to be downbeat. From a technical point of view, a confident rally is possible after the quote returns above the level of 1.1191. Sterling also slid on a worse than expected preliminary data on a business activity in Britain. The UK services PMI stood at 51.5 in July 2023, down from a 53.7 a month ago and below market expectations of 53. Likewise, the manufacturing PMI sank to 45 from a 46.5, while economists had forecast the indicator edging down to 46. The composite index fell to 50.7 compared to 52.8 in July last month, 52.3 falling short of the flash estimate of 52.3. Statistics also indicate that the UK is heading into recession amid rising interest rates, elevated inflation, and increased caution among customers due to economic uncertainty. Against this background, the British pound may well extend losses. If the quote fixes below the support level of 1.2817, sterling will dive to 1.2756 or even 1.2742. However, if the quote breaks above the resistance level of 1.2878 amid the dollar's resumed descent, the British currency will most likely return above the 1.30 mark. And that's all for now. We keep monitoring the financial market situation. Subscribe to our channel and see you in several hours. We will take a close look at the US trading session.